Hi, thanks so much for tuning in to BQ Prime. This is an earnings conversation. We're speaking to the management of Welspun India. Dipali Goenka is joining in. Dipali, thank you so much for speaking to Neeraj and I. And we're going to look at not just your numbers, but also get a pulse of the textile industry because of the kind of spread that you have both in exports as well as domestically. Seemingly, based on the commentary that we've seen through the year, you were expecting a bit of a muted quarter on the top line front. That seems to have panned out. But the dual headwinds in terms of issues in export markets and costs, at least one headwind seems to be easing out. We'll get into the second part in just a bit. But what can you tell us about the breakup of the revenues in the third quarter?
So let me actually, Alex and Neeraj, give you a perspective about the whole revenue and the kind of the basket that Welspun India has. So we've been talking about exports for the longest time, and it still contributes to the biggest top line revenue that we have. But our emerging businesses like domestic consumer business, flooring and advanced textiles have contributed 19% to the top line. I must also add on here that when we talk about our product portfolio, towel sheets, it's rugs, carpets, and utility bedding in the exports business as well. And along with that, our licensed brands. Our licensed brands like Martha, Scott Living, Creative Collab, they added around 175 extra shelf space in the American shelf retailer space. Now, I'm happy to also share Disney. We've tied up with Disney as a license for UK and Europe. That adds on additional space for kids, young adults as well, and babies too. So that definitely is again another, kind of a shelf space that we'll get in UK and Europe. Now, when we talk about India, we already are, the highest distributed brand, which is Welspun, in around 10,500 retail outlets. And we are growing to 50,000 by 2026. So this is what we are talking about.
Just a quick point, Neeraj, and then I'll hand it to you. But to delve a little deeper into that revenue picture, when we spoke last, or rather when Neeraj spoke to you last, you expected that third and fourth quarter would be muted on the top line side. This is panned out. But do you have more clarity? Last time you were talking about a possible lift off in the first quarter. Is it still a ways off? Will you have to push that down the road?
So, Alex, I'll tell you one thing. If I talk about the wallet share, during the COVID, the wallet share went to the home improvements and you saw that spike, right? Now, when we talk about that wallet share, that is going to experience, travel. You're seeing the hospitality business growing. But the wallet share to discretionary spends, like, ours, has gone down by 20%. So coming back to where we want to be, along with the inventory rationalization happening, it's going to be a stagger. I don't think so by quarter one, but the next year's half one, the latter part of half one, we see that coming back slowly. I mean, that's where we see it right now. Owing also to the recession, America is going through that slow recession. It's a resilient economy, but holding on to that 34% of the home textile contribution comes in from United States of America. Definitely, it's going to be a huge contributor out there as well. UK, Europe are going through their own challenges. But yes, to your question, Alex, latter half of half one is where we see it coming back. Commodity has gone down considerably, but the energy basket still is there where it is. You know how coal is. For us, our investment in renewable energy is going to help us to mitigate that risk going forward as well, which will be starting by quarter 1 2024.
Ms. Goenka, Neeraj here. Just how does therefore until the liftoff happens, and I know it's very difficult to call it, so you might right now you're saying the second half, but that may well change as the scene go by because it's very volatile. But how does therefore the operational metric picture look like in a scenario wherein utilization levels likely might be lower than what you would ideally want them to be, or ideally want the business to be, and costs, as you said, are choppy but still high. So would the stress on margins and utilization levels stay for the better part of the first half?
Yes, Neeraj. I must just give you a perspective there. So it depends. Now, today, if I look at our utilizations at our capacities, Towels is literally at around 75%.
Hmm.
Sheets is practically at 50%, and our rugs is around 50% again. But going forward, we've actually, in the rugs and the flooring bits, the bath rugs business on the retails and the big box retailers, we are looking at, we got one of the largest orders and rugs in the world right now globally. I think that could be one of the largest programs. So I think the China plus one is playing in and holding on strong there for us. So we will see that coming to around say 90-95% by next year. So rugs is there. Towels will be continuing to be around 75-80% till the retail shelves come to play. For us, sheets is going to be where we are going to see a little struggle, say around 55-60% will be where we are going to see. Hopefully that recovers, because as you know, for us, for us, 80% of our businesses are replenishment businesses. So that has held us in good stead earlier. But right now, with the kind of retail sales going down, we see that as kind of a setback. But as everything comes back and gradually comes back, we again will be holding ourselves better there. However, Neeraj, for us, I think the important thing, again, I want to repeat, our licensed brands will held us, that have held us good in even the toughest times. Our portfolio of brands has been now $100 million this YTD today. So definitely that's been an advantage for us.
Okay. So you reckon what the margins that you've clocked in, so to say, at the end of quarter 3, is that something that could be maintained, ceteris paribus?
Of course. I think, Neeraj, that's what we will see. Our margins will be maintained around this for sure. That's what we will continue to do so. Because I think I must also tell you, so, when the going gets tough, and for us in textiles, when with the manpower costs, the energy costs, everything definitely does hold us, the fixed costs. I think it's a challenge. But I think for us, we have worked considerably and diligently on our costs as well. And the digitization that we've seen happening at Welspun India actually will ease out our tax, the turnaround times, the speed to market, our inventories. Our inventories will get to the record low by the end of this year as well, and we'll continue to monitor that as well. So I think when the going gets tough, I think the focus on the key parameters is something that we're working on. The digitization and the turnaround times is something that so that we can we can actually, as the demand comes in, we are the first ones to, get on and turnaround times are better. Freight also, if I look at it, I think has been a very interesting one. So digitization on the freight as well, so that we have a visibility end to end, is also going to help us.
Alex?
Yeah, so I saw the reduction in cost of materials consumed. It's quite significant. From what I saw on the P&L, it's a 16% reduction on a year-on-year basis, and about that same number on a sequential basis as well. Is this the primary reason for the 500 odd basis point expansion in margins in the third quarter? Or, as you said, is there some element of optimization of processes? And could you also give us an understanding of where the high cost inventories were? We spoke last quarter and you said that was one of the parameters you're watching very close.
So I'll be very, I'll just tell you that, definitely the commodities ease has added on to that bottom line as well. And I think that was phenomenally very, very high. If you say that 80% of your costs was your raw material, and the other latter 40% or 30% is your landed cost on freight, I think it's insanely, you cannot do anything about it. So I think that has eased off tremendously. So I think that has definitely helped us. Now, when you're talking about the inventory levels, I think the inventory levels are in all pipelines. So for us, we are building now a pipeline for cotton. So now cotton is coming in. So we see, and we've covered cotton for around the next 5 months. And we are literally also working on what needs to be done there, because there is that little, kind of a precaution that the farmers are taking on right now. As the prices go down, literally the cotton arrivals are held on. So there's something that we are looking at. So we are taking a very conservative approach there, and we are working on cotton, as and when the right prices come in. So we already are covered for the next 5 months, and we'll continue to cover that there. For the inventory, as you spoke about, there's a whole lot of controls that we've taken on, whether it is raw materials, our WIP, and the finished goods. So in United States of America, in our warehouses, we are controlling our inventories there. In our retail business, we've come to from 105 days to 80 days of inventory. I think that again is significantly low. So everywhere that control is actually holding us in good space.
My last question, I'll hand it back to Neeraj after that. I see in your presentation there has been capacity addition during this year as well, though it's been a tough year. Your towel segment has seen an increase in capacity. Your bed linens has already seen an increase in capacity. I see first quarter of FY24, the rugs and carpets will see an expansion. But would you say that you would have to go a little slow FY24, and maybe certain plans that you had, and I'm sure you were looking at this from the longer perspective, you would put some of those capacity expansion plans on hold for now?
So our capex is done, Alex. Our capex, we were at the last leg of our capex. It's all done. It was around 250 crores that we would have done this year, and that is it. So our capex is already done. So whatever we did actually is done in the sense of that, our yarn sourcing or a grade sourcing was done from the market. Now that all comes within. So that will help us as the markets regain back. So we are, and I must also share, our debt is, it's significantly coming down. And we see in home textile next year, we'll be at zero debt. While the other emerging businesses we may take a couple of years, a year or two, but home textiles will be significantly, it'll be net zero next year. So I think we will see that happening as well.
Okay. Ms. Goenka, just one final question from my end. The conversation at Davos at the World Economic Forum this year was that manufacture in China for China and manufacture in India for India and rest of the world. Now, you're a brand owner, and therefore the texture might be slightly different for your business, but I'm still trying to understand. Have the quantum of inquiries, not for China plus one, but India for India and India for rest of the world, really expanded in the last 6 to 12 odd months? Because in textiles, there is a lot of competition from the other nations in the Southeast Asian region as well.
So let me break it up into the domestic and the exports, right? Let me just first the exports perspective. China for China, of course, because they have a huge economy, and I think for them that consumption is huge as well. But for when we talk about India, India is becoming the heart of kind of a sourcing, and I think that is going to really consolidate the vision of that 2 trillion exports from India in all aspects. So the opportunities in the infrastructure, the whole ecosystem that we're talking about, the SEZs, the whole logistics turnaround times that we're talking about, the PLI schemes in the man-made fiber, because that's again was something that India was not very competitive on, I think is something that we see definitely is going to hold us in good stead. So India definitely is a good place. And why not? If I look at my neighboring countries and our neighboring countries, they are struggling. And even if they are giving them far more, last year, I think India was at a back end because, at a disadvantage because our cotton prices were higher than them, than our competitive countries. But even the supply chain will be a problem in the competitive countries that we're talking about today. So India definitely is here to gain. So that is from the export market. And companies like us, I think the advantage that India has is that we have integrated supply chain. That is all of us in India,
sure.
A very integrated supply chain. Now, coming to the domestic India for India, India is a growing economy. Now, if you're looking at the growing economy of around 6.5% growth here, inflation at 5.2 compared to China, compared to USA or UK, we would be the lowest. So I think that's where we see India market growing. And the opportunity here is immense as the consumer index is growing as well. We saw the retail index grow tremendously by 14 to 15%. So I think that's the advantage that we have. So India for India definitely is here to stay for a long term.
Okay. And India for the world as well, hopefully. Great. Good talking to you, Ms. Goenka. Thank you so much from us here at BQ Prime, and all the best for the quarters ahead.
Thank you. Thank you so much for talking to me.
The pleasure was ours. Viewers, thanks for tuning in.
Thank you.